So how much and what kind of taxes will you need to pay when you sell your company? And how do we get those tax liabilities to be lower? I'm Malcolm Zoppi, an English qualified solicitor, and in this video, we will discuss the tax considerations when selling a business in the UK. First, we'll discuss the two main ways to structure the sale of your business, namely the asset versus the share sale option. Then we'll go through the different taxes that are relevant when selling a company and determine whether those taxes apply to your chosen structure. And lastly, in chapter 3, we'll discuss how to pay less in taxes. Fantastic, let's get started. So chapter 1 is asset versus a share sale. When looking to sell your company, you'll need to agree with the buyer how to structure the sale and purchase of the business. The two main options are via share purchase or share sale or an asset purchase / asset sale. Now, a share sale is when you sell your entire limited company via the sale of the shares that own the limited company. You, as a person who holds the shares, is the seller in this transaction, and the buyer is buying the entire limited company. Let's call it a basket of fruits and all the fruit inside of that basket. With an asset sale, the situation is a little bit different. The seller is the company itself, not you who owns the company. And the buyer is only buying certain assets or certain fruit from that basket and leaving the basket and all the other fruit behind with the seller yourself. Typically, it is preferable, at least from a liability perspective, for the seller to engage in a share sale because it's a cleaner break. They hand over the entire company and they're simply left with money. Instead, with an asset purchase, the seller is still left with that limited company and some assets, including also known or maybe even unknown liabilities that weren't expressly transferred to the buyer. And then the seller still needs to figure out how to, number one, extract the money from the selling company to themselves. And number two, what to do with the limited company once effectively it stops trading because it sold its most important assets to the buyer. Fantastic. Moving on to chapter 2, which is taxes. In this chapter, we'll discuss the four main types of taxes that typically are relevant when selling a business. These include capital gains tax, corporation tax, value added tax, VAT, and income tax. First, let's look at share sales. With a share sale, typically the seller would be expected or would end up paying capital gains tax on the gain made on the sale of those shares. Typically, with a share sale, there is no VAT, no corporation tax, and no income tax payable. Moving on to asset sales, which are a little bit more complex. First, we might have corporation tax payable by the limited company that disposed of assets at a profit. Second, it might be possible that HMRC decides that VAT might be payable on some of the assets that have been sold, but this is typically avoided by arguing that the sale, the transaction, was the sale of a business as a going concern. And lastly, we might have income tax and capital gains tax considerations when trying to extract the money from the selling limited company, because again, it's the limited company that sold the assets to the buyer, and therefore it's the limited company that receives the money. So then we need to extract the money, and therefore we might again have those capital gains and income tax considerations. Now, it is important to note that although I am a solicitor and I work in the M&A space, I am not a tax specialist, I'm not a tax lawyer or an accountant, and therefore you should seek independent tax advice to ensure that the information is relevant to you and to make sure that you receive the correct advice. Now, before we discuss how to minimize your tax liabilities, make sure to send me an email if looking for professional legal advice. With our legal advice calls, there are no charges, no obligations, and no nonsense. Contact me now at info@zoppi.co.uk. Fantastic. Moving on to chapter 3, where we discuss how to minimize your tax liability. Well, the first thing that you should at least consider as a seller is to engage in a share sale because from the start, it is typically more tax efficient. Secondly, although you might have capital gains tax payable on the share sale, you might be able to benefit from a business asset disposal relief, formerly known as entrepreneur's relief, which reduces your corporation tax rate down to a minimum of 14%. And lastly, you might want to at least consider speaking with your accountant about leaving the company's cash in the company instead of extracting it, paying corporation tax and distributing it as dividends, and therefore also paying dividend or income tax on it. You might just want to consider leaving that money in the company's bank account, and as part of the share purchase agreement, make it so that any money that is left that wasn't expected to be left in the company is to be added onto the purchase price, and therefore you receive that money as consideration for the sale of the shares that again you sold to the buyer. So effectively the difference there is that instead of extracting the company's profits or the company's money as income, you receive it as consideration for the sale of the shares. As always, if you have any questions, feel free to put them in the comments below. I will make sure to answer any questions that you have. And if you're interested about the structure that we just talked about regarding the share purchase agreement, whereby you add money to the purchase price depending on how much cash is in the bank, then make sure to watch this video right here, which talks about that exact mechanism, also known as the cash-free, debt-free mechanism, the most popular option that I've seen when it comes to structuring a share purchase / share sale. Thank you for watching.